Hello, my name is Juan Mesa Romero, and this is my project showcase. I'm working on my own business idea. The objective of this business is to provide education and recreation via soccer lessons to children in primary school years. Therefore, my problem is to establish the financial feasibility of this project or business. To perform this financial feasibility study, we will determine the following. First, the initial investment or startup capital, and establishing once-off costs and annual costs. Then the cash flow projections, determining also the sales projection, the cost projection, and the personal cost projection. After that, we will do a discounted cash flow analysis, determining and calculating the net present value and the internal rate of return of the project. To properly do this discounted cash flow analysis, we need to calculate the weighted average cost of capital based on the formula according to the textbook. And to determine the weighted average cost of capital, we also need the beta of the industry, which we will calculate according to available betas of the education and recreation industries. Then we are going to establish alternatives for initial investment, business loans, and also attracting possible investors. Finally, we are going to determine the potential return for investors. To do that, we are going to calculate the cost of equity capital according to the formula according to the textbook. Going to the calculations, this is basically the initial investment or startup capital that we have determined for this project, determining also the annual cost of the project. Then we did a projected cash flow for 30 years. 30 years is up until my retirement, because this project will be part of my retirement. And the components of this cash flow projection are three components. First component is the sales projections, also for 30 years here. The cost projection, also for 30 years, the annual cost projections, and the personal cost projection. Personal cost projections specifically because this is the main component of the cost structure of the project. And then we basically built the net cash flow for 30 years, which is the time we are working on for the project, and do a first analysis and determine the net present value and the internal rate of return of the project based on a discount rate, a random discount rate of 20%. However, to do this properly, we need to determine a net present value based on the cost of equity capital, and also a net present value based on the weighted average cost of capital. Now, to do that, first we determine the beta of the industry. To calculate the beta of the industry, we basically took available betas for education and recreation industries. Betas are pretty similar for these two industries, and we calculate the beta of our industry. The source of this information is the New York University Stern School of Business. Then we basically determine here the potential return for investors. The potential return for investors is based on the formula according to the textbook. So we need to determine RS, which is the expected return, and we need the risk-free rate, the beta of the industry, and the expected return on the market, or the premium rate of the market. So the risk-free rate is in this calculation is 297%, which is the Australia bond 10-year yield, and is sourced at the Bloomberg website. 7.14% is the expected return on the market, or the premium rate of the market. This is the implied market return as at 31st of January 2017, and this website is the source of that information. So we calculate a cost of equity capital of 661, and with that we did our first discounted cash flow analysis here with this obtaining this net present value of the project. After that, we just go and check alternatives for initial investment. So we gathered information about business loans in commercial banks and obtaining interest rates and monthly repayments for a debt to calculate the efficient debt and equity ratio for our project. After that, we analyzed the balance sheet of this soccer company. The name is Belconnen Soccer Club Limited. The interest-bearing loans and borrowings over equity ratio, which is basically the same debt equity ratio for this company, is 1649%, which we can assume that will be a good proportion for our debt equity ratio in our project. The source of this information is company 360. After that, we just went to calculate the weighted average cost of capital based on the formula according to the textbook. The total equity and total debt for this formula is calculated based on this 1649% efficient debt equity ratio. So basically this should be our equity and should be our debt. In total is basically our initial investment 20,000. Our cost of equity capital we have calculated before. The cost of debt is the interest rate on the business loan. The interest rate is 781%. That's according to the information we gathered before from commercial banks. And 28.50 is the taxation rate of the business. The source of this is the ATO website. The calculation is a weighted average cost of capital of 6.44%, which take us to our final discounted cash flow analysis, obtaining a net present value with this weighted average cost of capital. In conclusion, this business is financially viable and is financially profitable according to the discounted cash flow analysis we have done. It is financially viable and attractive to possible investors because it has a moderate amount of initial investment, and also it has a cost structure that can be easily absorbed by the sales projections. Even though our sales projections are a bit optimistic, the big conclusion is this project is viable, is attractive for investors, and is financially profitable in the long term. Thank you very much for watching and listening.